So the topic for today is shareholder activism, and sort of been involved because I got involved the first time because a couple of clients that we worked with were approached by activists, some fairly early on in this game, and it used to be something that was only of passing interest in the Northwest, even though there was one company that's since been acquired, Fisher, that had an early activist. Mario Ravelli is probably one of the, he's not in the news as much as an activist, but he's been kind of a quiet activist. He has not run a lot of proxy contests, but has run some. But largely, companies out here felt relatively immune, and whenever the topic was featured on a panel like this or a continuing legal education program, there were a lot of glazed eyes over there, and it had some, every once in a while there was a headline in the Wall Street Journal, so people were interested for that reason. But these days it's something that's with us almost on a daily basis, and there are very few companies that don't need to worry about activists, and I think these days I would say that there are probably no public companies that don't need to worry about activists in some way, in some form or another. So, and I was on a panel, and once a group of us tried to figure out what, if there's a definition. And so this is what we came up with. I think it's more interesting to the grammar fans here, or if you have kids that you need to teach the difference between effect and affect, it's here in the definition. But I mean, we try to capture the whole range of activists, and so it's anybody who's seeking to effect some kind of a change. Principally, I think most of the activists that we hear about, they want to effect a change in order to cause a change in the share price. But increasingly, because the number of funds that profess to be activist investors, or that at least try to get into the game, has increased dramatically. And there are spin-offs from some of the well-known funds where people, the younger generation that has relationships with their investors, will go off and break off. So some of the activist campaigns are also designed to generate some publicity and enhance the reputation of the activists. And the other objective, and the one that's increasingly, or should be of concern to a lot of public companies, is to attract like-minded investors. And these days, like-minded investors include funds like huge asset managers like BlackRock, like Vanguard. Don't see Fidelity as much. You don't see T. Rowe as much aligning with activists, but certainly, BlackRock has not only aligned with activists, but some of their both their proprietary investing and their client investing has invested in some activist funds as well. And these days, the activists come in all sizes and shapes. It's not just a few well-known people like, who've been doing it for eons, like Carl Icahn and some of the others. Some funds have a single strategy, others have multiple strategies that they'll employ. There are a number of fund that's closing now because of some health issues that the founder is experiencing. Relational, which is based here on the West Coast in San Diego, was known primarily in focusing on return of capital. That was, they had very few other issues that they would focus on. But these days, funds will use whatever leverage there is, whether it's governance related, whether it's return on invested capital type issues, and others. Some are cooperative, some are always aggressive, some are both, and some are focused on particular industry sectors, and some are sector agnostic. More and more of them are sector agnostic, although there are some that tend to play largely in technology sectors, some that, retail is another favorite area. Anything that particularly companies or sectors that experience seasonality typically will attract activists, just because you see, some predictable volatility. These days, with the markets being as volatile as they have been, it creates great opportunities. What's driving the rise? And there has been a very meaningful rise in activists. I think fund inflows are probably the single biggest factor. There was approximately $45 billion in activists invested in activist funds in 2010. At the end of last year, that grew to $115 billion. Today, there's just an announcement that one of the Neuberger Berman managed private equity funds took a 20% stake in JANA, which is one of the large players. Most recently, they were very active and caused the sale of PetSmart, for example. They were also had a campaign with Outerwall. The returns have been attractive, although it's interesting over last year. The activist returns have been on average below S&P. If you just took an S&P index fund, so they're not always. They don't always outperform their market. I think one of the attraction is that some of them have had very large hits, and so that generates a lot of interest, obviously. And again, we talked about the large investor alignment with the institutional investors. Size and industry don't matter anymore. Microsoft has had activist investors. Apple has had activist investors. There's currently a campaign to get an activist on the board of GM. So you see all sorts of companies that are generate interest from the activist community. What it is that makes companies vulnerable, I think number one is excess cash flow, low debt, and typically that'll stimulate a campaign to return capital to shareholders through buybacks or special dividends and the like, and that's a favorite. Anytime a company has multiple business lines or a large piece of owned real estate, that represents an opportunity for an activist campaign to break up the company, sell a portion of it, or spin off a portion of the company. Then we get into more of the corporate governance kinds of things, management, board composition. Management has been around for a long time. Another area might be if a company has failed a say on pay vote over maybe a couple of different proxy seasons. Board composition is increasingly being targeted. ISS came out earlier this year with their position that any board members who are have over 9 years in tenure on the board will be viewed with some suspicion, which seems highly arbitrary, but that's ISS. Another one is undervaluation or overvaluation. One thing to remember is that there's also a lot of short sell strategies that activists employ. So, and a prime example of that is the battle between the two prominent activists in Herbalife. where one of them is taking a short position and the other one otherwise have taken a long position. And then there's increasing activism in connection with M&A activities, announced activities, and there have been a couple of examples where activists have come in after a transaction is announced, and either they'll take before the record date for the acquisition is announced, they'll take a significant position and then campaign actively against the transaction, hoping that there's a better opportunity. So, oops. The other areas, governance. You have some activist pension funds that will use governance, and they usually for a non-economic motive, social, political. I mean, the most obvious is adding directors through a proxy contest or removing directors, attacking board structure, threatening to replace management, and also attacking compensation. The last one has been particularly in favor with some of the more hostile activists, just because it's personally embarrassing to senior management, and so it extracts a lot of sort of publicity value that way. We've talked about capital structure, and then strategic direction. Usually that's a buzzword for selling the company or make significant divestitures. We talked about trying to impact announced M&A deals. I think any company that has been acquisitive is likely to be a target for activist shareholders. As you all know, having worked with companies or been in companies that are fairly acquisitive, a lot of acquisitions don't work out. But a lot do, and so the argument, put fairly bluntly, is that the money that would have been that was used in an acquisition would have produced much better return if it was returned to shareholders through buyback or dividend. And in fact, there are an increasing number of companies that have actually announced that one way that they evaluate acquisition is comparing the expected return for the acquisition over a return that they would get by an equivalent stock buyback, which is interesting. Now again, it all depends on the assumptions that you make about your acquisitions, and so that's not necessarily. I think it's a good way to test something, and I think it tends to have some appeal to investors. So I think from a investor relations standpoint, that's something I think that ought to be considered as one metric to evaluate acquisitions.
Is it true that stock buybacks don't also have the best track record in terms of overall success?
I'm firmly convinced that they don't.
Okay.
And but it is something that investors are expecting more and more. It is something that has really become. There are very few companies that I'm aware of that don't have some kind of a buyback in place, whether it's significant or not. And it depends on individual companies. There's no question they can result in, the announcement of a buyback typically has an immediate effect. Sometimes it lasts a little longer. In some situations, we've seen an announcement of a buyback, and then the activist takes advantage and exits soon thereafter.
So it's like the opposite of trying to create loyal shareholders. It's the return of capital, gives the investors that wanted enough of a return that they then exit, so they're no longer a loyal shareholder. It's from the company's standpoint.
Or it might make them happy enough to not become activists. Gives them a little something back in terms of the
just
value.
a little spiff to go away. So.
Well, or just looking at what their investment was and whether they gained or lost on it. So, but you're right, you're focusing on what the impact is to them and what their incentives might be.
Although, but there are also situations where exactly that has happened, and a lot of activists will fluctuate their position in a company. And so maybe they don't sell down all the way. A lot of them will enter and exit and then re-enter. And so just because they were happy at one time doesn't mean that they might not come back when when they perceive a good opportunity. So I don't think that I don't think companies can ever relax, and I think it makes sense to stay in touch, and they will ping as well. So what is the activist playbook? I think this has been fairly well covered. It usually starts with a letter to management or a phone call, especially if there is some connection. I think these days, particularly the better known funds like JANA and like a lot of the others out there, they now realize that their name means something. So if there is a call, that tends to get attention. So usually it's either a phone call or a private letter. Very often these days the letter's addressed not only to management, but it also copies the board, or at least the chairman, or if it's a non-executive chairman, or the lead independent director, so that they know that companies will not try to deal with it without taking it to their boards. Sometimes it's the letter goes directly to the board. There are some firms that just don't do much, and then they lob in a 13D. That's relatively rare, but there are, and it depends on the size of the company. Obviously, if you're a mid-cap, small-cap, micro-cap, it can be relatively easy, particularly for some of these larger funds, to take a 5% position fairly easily and choose to file a 13D rather than a G. White papers are being increasingly used that may be either private or public, and they may be sent to several companies analyzing 3 or 4, and especially, and there are situations where the activist or the fund will say, well, we're trying to make up our minds about which investment we ought to make next, and here's, we're looking at you among others. Engaging with other shareholders, obviously critical to their success. Threatening a proxy contest, again, and that's something that's starting to change a little bit. I think a lot of the activists, because of the success they've made, because most companies now have either experienced it or have heard of enough stories from other companies that have experienced it, and how disruptive and how expensive proxy contests are, so that they know that they don't even have to threaten it that much, that just by showing up, they'll usually get attention. So you're seeing fewer, I think, the number of threatened proxy contests has gone up, but as a percentage of activist campaigns, I think it's come down relatively. Shareholder proposals of various types, and then more aggressively consent solicitations, depending on the structure of the articles of incorporation or the bylaws of the company. If they permit vote by shareholder consent, you may see some of those. And there's often a call, either through a 13D privately or publicly, call for for a company to examine strategic alternatives or an outright sale. proxy contests we've talked about, and challenging announced transactions. So how do we all manage activists? I think vigilance, I think, is necessary, and I think that's where you all come in to a large extent. I think the investor relation function is used to monitoring, and it's often hard without really doing it actively to monitor shareholder positions in real time. And there are firms, as you know, that have made it a specialty to try to monitor that by monitoring activity, by using different trading patterns by some activists. Just normal communication, investor calls, interaction with analysts. I think, particularly before a nomination or a shareholder proposal deadline is important, and that needs to start relatively early. I think for calendar year companies, typically you want to be doing something like that in the fall. Just trying to get a sense if there is some unrest among the shareholder base. And then the easy one is monitoring SEC filing. Then once you suspect that there may be an activist, or you actually do get approached by an activist, I think then companies do need to react. I think the key to this is, and I think companies are getting better at this, the key to that is to treat it just like another event. Because the reaction, particularly by companies that have not been exposed to activists and that have enjoyed relative success, and all of a sudden they're having to deal with it, there isn't just a huge sort of first a denial that this is all happening, and second, just genuine kind of a reaction of being wronged, and how could somebody do that? And we've had great returns. Shareholder base is happy. How dare they? And that's that's the wrong kind of reaction. And so I think it needs to be treated just like any other challenge that a business is facing. And the whole key is to make sure that it doesn't distract more people than it should. Because I think sometimes it's just you get this raise the drawbridge mentality, and it's kind of a sense that we're all in this together, and we need to repel the activist, and it rarely works, and it gets people distracted, which can, especially for a small company with limited resources, where a number of the key people have multiple responsibilities. If you're diverting them to dealing with activists, they're not doing their day job, and which can then lead the company to not perform as well, particularly for smaller companies. Who are the usual team members? Should be certainly the CEO should be involved. I think most of it will fall on the finance function, along with investor relations and the general counsel. The board, and again, the key is, I think, at least from my perspective, is to keep the board aware, but make sure that this does not become kind of the overwhelming topic of conversation at the board level. Because then not only are you dealing with the activists, but you're also dealing with your board members, and that can really distract everybody. It's also a tendency to try to form special committees right away. There's really no need, especially from a legal perspective, there's no need to form a special committee when you have an activist in place. And most of the time that can lead to additional distractions, because at least most boards that I'm familiar with are, especially when it's something that may end up in the news or is definitely of interest, which this always is, there's always a desire to be involved, and so the rest of the board, the members of the board who are not on the special committee, want to kind of get information almost on a real-time basis. So they not only are you dealing with the special committee, you're usually, if you're the corporate secretary or the investor relations group or the finance group, you're then having to keep the communication going between the special committee and the rest of the board members, and so typically I would see very little reason for special committees in those circumstances. And then typically you'll want to involve some outside experts, maybe your outside counsel, investment bankers, and once the activist, or if it's an activist that has a pattern of going public, or you know that there's a high likelihood, I think that's a good time to consider retaining a specialist firm, IR, PR type firm, and start talking to proxy solicitors. And there, I think another example of how pervasive activism has become is the proliferation of the specialist proxy solicitation firms that we get visited by them regularly, almost monthly. Often they're spin-offs from some of the larger proxy solicitation firms. Sometimes they're, they bring together a variety of disciplines that may have resided in different kinds of firms, and especially the monitoring of the shareholders, and increasingly on the governance side, a lot of the proxy solicitor firms are bringing in people who were ISS or one of the other proxy advisory firms, just to get a better sense. And some of them are also hiring the corporate governance people from institutional investors, like a BlackRock or like a Vanguard, and to try to provide that kind of support. So there are a lot of choices out there, and some of the firms are stronger than others in a particular area, and it also depends on your shareholder base. I think the one thing that is absolutely critical is communication, managing communication. I think engaging with an activist is critical. I think trying to, a lot of the funds are run by people who have outsized egos, and they don't like it if their phone calls don't get returned, or if their letters or emails don't get answered. So engaging is good, I think, and the other goal, I think, of a successful communications campaign or a successful campaign with an activist is to try to keep it out of the public eye as much as possible, because that's when it becomes really distracting, and that's when typically it gets out of control. And I think if it's a constructive dialogue, and if if you approach it, well, they are just, they are another investor, and maybe they're not a large investor, and some companies will have policies that they will take calls, or they will meet with investors over a certain size. And for a large cap company, that could be huge, but if they get approached by one of the well-known activists, I think that may be the time to relax that kind of a policy about what you're going to meet with. Second, I think the way you communicate with the board has to be thoughtful, and I think fairly frequent, but certainly not daily communication is essential. Again, it's the kind of the art between keeping the board informed and yet not creating a day job for all of your outside board members.
Andrew, in terms of getting the letter or the call, wouldn't there almost always be some kind of foreshadowing, or
or does it really just kind of come in out of the blue?
Well, you know, there can be some foreshadowing. Typically, the one thing that is probably a very good sign is if on quarterly earnings calls and the Q&A afterwards, if you start getting sharper and sharper questions from some of your longer term holders. I mean, clearly, if somebody is known to be from an activist fund, they're already in your stock, you tend to know it, or if it's kind of a hybrid fund, or if they can go, that gives you some idea. But if some of your long-term investors start asking, more difficult questions, I think that's a good sign that there's an activist out there who's been talking to them, and certainly got their attention. So, defensive priorities, and I think we're, this is all in the materials. The best thing is to make sure that companies have a very clear strategic long-term plan, and that the spokespeople for the company, including directors, know what the company's strategic plan is and can kind of give an elevator speech about it if needed. Talked about communication strategy, response team. Companies ought to be well aware of what the all-in costs of dealing with activists are, and they're all the direct costs that you have with outside advisors. It's also the strain on resources, and I think the biggest cost is distraction, ultimately. Preparation is key. We talked about constructive engagement, and then what do you do in response? I think more companies are agreeing to do some kind of a return of capital, what we talked about earlier, or through either repurchase, dividend, spin-off, or divestiture, and then taking the proceeds of the divestitures and either declaring a special one-time dividend or using it for a buyback program. Announcing that you're investigating strategic alternatives. Typically, it usually means only one thing, and that's that you're actively shopping the company. Sometimes you don't, and you might announce a change in direction, or after that you might announce a divestiture or something of that sort. Proxy contest, we talked about.
So Andrew,
yeah.
In terms of communication, and I haven't been involved in an activist campaign, but I can imagine that the dialogue that the activist wants to have with management gets into areas that aren't in the public domain. So how do you have those conversations, and what can you talk about?
Well, and that's very interesting, because you have, you're subject to Regulation FD. The one way that you can get out of or be compliant with Regulation FD is if you sign a non-disclosure agreement. And usually, that may happen at some point if the activist is trying to wage a proxy contest. They will not be interested in an NDA because they will not want. Yeah, well, they won't be able to trade, and they also will be in a very difficult position when they're fielding their own proxy statement. They may have information that they might need to share, or otherwise risk an argument that their proxy statement is misleading because it omitted certain things. So they won't want to be boxed in. The principal reason is not trading. So the best you can probably do is have an NDA with a very short term duration, and they'll be very specific about the kind of information that they'll want. Typically what they will do is, and they'll be prepared by the time that they meet with you, especially if it's a larger firm. You know, they will have they have sometimes seen like armies of you know, brand new MBAs who've been crunching numbers and populating various models, and they'll come prepared. And so you can, you know, it's like meeting any other investor presentation. I mean, I think your CFO and people who would be meeting with them, CEO and CFO, need to be prepped, just like they do for especially one-on-ones or attending, whether it's industry conferences, investor conferences, that sort of thing. It's that. And the trick is to just to reinforce kind of your announced strategy. Maybe they have misinterpreted something, so you know, it's not necessarily material. So it's that kind of approach.
I guess following on that last comment, I'm sitting here thinking it's maybe one of those things that with hindsight you wish in your most recent Q you had elaborated and kind of kept refreshing your statements around your strategy, because it would give you that something to speak from that keeps it from being new information. Particularly if you think it's something, maybe some pressure may be developing, and you really do think that your internal strategy, I don't want to get out ahead of the headlights, of course, in your disclosure, but it's
and you do see that there's been a greater trend, you know, particularly companies have announced, whether it's in response to, you know, private approaches by activists, or whether this is something that they're doing just as part of their normal review, if they've announced sort of a major restructuring or a cost-cutting initiative. You do see a, you know, fairly robust discussion of that, and kind of the anticipated payback time, payoff time on that kind of an investment, so that they can both, you know, try to deflect and also set the stage for being able to discuss some of these things in greater depth. But it's the trickiest part of that, because your instinct is to, you know, particularly when you look at their models and you realize there's some glaring errors in their models. I mean, they're usually, I mean, sometimes they're quite good. I mean, they're almost always designed to reinforce that particular activist thesis. Very often, you know, return of capital. That is more and more popular. So, you know, sometimes they will have missed something, and it becomes tricky. And I think sometimes you can, because these discussions can go on for a while, you might have the opportunity in a subtle way of the next filing you do is create the groundwork for getting into a little more in depth. It's about the team, and here's an example of a outline of a proxy contest, materials. You know, different strategies can be employed, or a combination of all of these. I mean, those are probably well known to all of you here. I think the one area that I know companies find very frustrating is when they hear, and sometimes it's true, sometimes it's not, and sometimes it's somewhere in between, where they hear, and the activist will say early on, well, we've talked to some of your other shareholders and they're not happy. And at the same time, you've had, you know, you may have just come from an investor conference, you may just have come back from a non-deal roadshow or whatever, and you know, you've had fairly positive responses from your large investors, and so, you know, you're trying to calibrate that, and you know, you never know, and you know, somebody who's following you may not necessarily be the same person who's talking to the activist, but that's something that I think is difficult for a lot of companies, and it's sometimes difficult to to get behind, because obviously a long-term holder wants to maintain good relationship and a fairly open dialogue with the company, and so they may not be entirely transparent with you. That's one of the challenges. Sharon?
Well, some of the larger investors like BlackRock and Vanguard, who are sometimes targeted by activists, will they tell you if they have been getting inquiries from activists about your company?
Some of them will. They will almost, unless it's already been public, and then they'll say yes, we've been approached. But if it hasn't been made public, they will never tell you who it is if it hasn't been made public, because they really want to protect those kinds of discussions. But and some will just they'll say no, we can't comment on it. We talk to a lot of people. And here's some statistics recently. I think the one that's telling is the difference between the 2009 to 2012 timeframe in who's scored one proxy contest to the more recent example, and activists do tend to, not always, and it depends a lot on what kind of, if they do engage in a proxy contest, do they really focus on getting one or two people on a board, or are they running a full slate, or in the case of a staggered board, are they running a kind of a full, full three-person slate at that time? Typically the advisory firms, proxy advisory firms will, especially if the company has been underperforming, they'll tend to support usually one or two, but usually not all three, or certainly that they would not support. Typically they don't support a full slate unless it's a situation that's been going on for a long time. Which is not to say that companies have not been able to win. I think it's very fact specific, and it depends on the company's resolve. And there have been a number of situations where companies decided to settle even after they have convinced the proxy advisory firms to support the management slates, just because that activist either is still going to be there or may come back and is very.
Just to follow on that, are the settlements usually, not that I know very much about them, but are they usually accompanied by some kind of cooperation agreement? So
they're usually they're inevitably accompanied by a standstill agreement. Typically, in exchange for getting a board seat, they will, for a period of time, and it all depends on your negotiating leverage. They'll agree not to do anything publicly. They'll agree to maintain their position, or not to exceed a certain level if they're over 5%.
Is there a typical time frame developing? I know, I'm sure it's very fact and company specific, but is there kind of a range normal?
It's very specific. Typically, it's somewhere between 1 year and 2 years. Rarely do you see it go beyond 3 years. You may, in some circumstances where it's been a relatively cooperative process, they may, if it's a company with a staggered board, and if that person is appointed to a full 3-year term initially, if they're a candidate, they may agree not to do anything as long as that person is on the board. And then typically all bets are off if that person goes off the board. Whether or not it's because that person has been renominated or leaves. So the best way, and this is more directed at directors, but I think it applies to everybody, is just be prepared, and have an occasional it's good corporate hygiene to review these things, you know, at least annually if you're in a relatively good position, or more frequently. But you know, you don't want to make it just another line of business of preparing to deal with activists. And then I think we've covered a lot of these things, but the last 2 pages in the outline, I think, hit the highlights of things that are constructive and things that are not constructive. And I think particularly for a company going through this for the first time, focusing on things not to do is a good place to start. Just because some of these things are things that people naturally want to do. And resisting the urge to respond if it's a public campaign that an activist is mounted, resisting the urge to respond immediately, and having a sort of a point counterpoint, and trying to take every one of their points and presenting an argument usually does not result in a good situation, because part of their goal is just publicity and keeping, and the more you stay in the public limelight, the more likely it is that they'll attract other investors. And also, the harder it is for the company to try to maintain some kind of control. So a thoughtful, considered response on key points is much better than trying to engage in a debate on every single point. I think that's it. Jeff?
Dividend payout ratio. Has anyone ever looked at sort of what a strong and consistent increasing dividend payout ratio, the correlation between that and activist campaigns? I mean, if you've got a good record of dividend payout, is that sort of a natural immunity?
I mean, it depends so much on the company. I mean, if you're just a solid cash generating company, and you have enough visibility. I mean, obviously, utilities are a great example of that. Yeah. And very few utilities have been subject to, unless they go off the rails, and typically where utilities have been subject to some activist campaigns is if they overinvested in non-utility businesses. That's one area. Yeah, I think that if you do that, it depends, because the pressure, most activists that focus on this will push you, and the issue is that if you agree to be, it's much easier to increase a dividend in the future than it is to cut the dividend at some point in the future. So if you're committed to a dividend payout ratio that maybe is pushing a little bit on what's comfortable, and then you hit some kind of a challenge, or it's difficult.
You've got this situation though, if you have excess capital, right, and then you got to have a dividend payout ratio above 100, otherwise you're not going to be bringing down the excess capital to a level sufficient to satisfy them, I don't think.
That's the whole key. It's payout ratio be buybacks and dividend combo, but if you have excess money, they want it.
Mm-hmm.
Well,
that's where you've usually been doing regressions and looking at what activists buy.
Or you've seen, Costco is a good example. They had, a huge one-time dividend. Part of it was tax-driven.
Yeah.
They did that a couple of years ago. But one way to handle it is through a one-time dividend if you don't want to do a buyback program.
So if the process began, or probably wouldn't begin this way, but at the point that the activist goes public, what typically is the way that the company bonds? I mean, would they do it in a voluntary 8K? Would they just wait till they're, I mean, and I know, I'm sure every specific case has its different specifics, but is there a general rule of thumb?
Typically, you would do it if you do want to respond publicly. You would do it in an 8K. I mean, the activist has, unfortunately, the way it's these filings work. All they need to do is amend their 13D, and then, and if there is an active campaign, there are these so-called fight letters, and those are always filed in an 8K, and they go back and forth. And it's just that, you really hope that your company or your company's a client or whatever, that doesn't get to them, because the amount of time that it consumes and it gets increasingly hostile. And it also, if you want your board to keep resolve, those kinds of things are usually counterproductive, because I mean, most board members, quite understandably, if they're the ones that are being attacked personally, and it will happen, and if there's a proxy contest and the directors were standing for re-election, again, if it's a company with a staggered board, just luck of the draw that these 3 directors are being attacked. Most of them have a very understandable reaction that they didn't sign up for this, and they'll be looking to settle. So I think as part of the preparation, need to have very frank conversations at the board level too.
In terms of being prepared for, say you don't have anything, but you just you want to be in the best possible position in case something comes up, is it good enough just to have active dialogues with your investors on the the analyst and fund manager side, or do you recommend actually reaching out ahead of time, not knowing there'll be a proxy issue, but just in normal course of the year saying, hey, I want to talk to your corporate governance department, and is that even feasible, or will they just say, no, don't worry about it?
I think it depends on the, I know a lot of institutions have policies where they're, if their corporate governance departments will even engage. I think that the buy-side analysts always will engage. I think it's increasingly important to have something beyond just the quarterly earnings calls, and whether it's it doesn't even need to be annual, but a non-deal roadshow. Particularly if you're not widely followed as a company, is a good idea. But on the governance side, that's difficult. There's some institutions that will, and now it's fairly readily available which institutions, for example, always follow ISS, which institutions will sometimes follow ISS, which will make their own decisions. I think as a practical matter, it's for the large institutions, it's almost impossible to do this on an individual basis. And then and some have policies where they'll meet with their with the companies and can be persuaded. And I've seen lots of examples where we've been able to reverse voting. Usually not where there is an activist campaign, but in order to forestall something. For example, I mean, there are lots of examples where you can convince institutions to turn around on say on pay, for example, and even and it's interesting because some companies and directors especially will care, even in the context of a special shareholders meeting to approve a merger or sale of that company, where you have the vote on golden parachutes. And most companies that I work with, that have worked with in this context, have really wanted to win that vote as well. Anything else? Thank you.
Thank you.